everybody should have a will. Outside of having a will, what you're talking about, things like live-in trust, there are things that you can do before you die. Because for those of us who are in Canada, in the States, in other part of the developed world, there's taxes, right?
Right.
And so when you pass your estates or your estate, that's what it's called. When everything you leave behind, it's called the estate. Your estate has to pay taxes on what's left behind. So you could do some planning. So you shelter, which means you keep some things out of. In Ontario, we say the CRA. I think US, you guys say IRS. Yeah, you keep it outside of the CRA or IRS hands as much as possible, or limit how much money you have to pay them to give away things that you've worked for very hard in your life to earn. There are things that you can do. Some of those things are things such as the live-in trust. I can't speak to the idea of creating live-in trust accounts very much because I don't have a lot of experience with, but the tax planning things that I can speak to, I will. So from before the will stage, one of the things that people can do, this goes to parents, couples. For me, if you've moved in with somebody and you guys are living in a house, then like you should be able to have some kind of a joint account together. Parents, if you're getting elderly, you should at least have one child that you feel comfortable having a joint account with. And the reason why I say having a joint account is, obviously there's risks to joint accounts, right? Because person B that you're putting onto your account has the same rights that you have to this account when you make it joint. But it's helpful for estate planning and tax purposes because once you pass, the second person on that account automatically becomes theirs. And it becomes theirs and it passes out of the probate process, which means CRA doesn't tax you on that money in those accounts because they now automatically belong to somebody else. You take them out of the estates. That's one example, joint accounts.
Sorry, that CRA taxing that you're mentioning, someone had a joint account and unfortunately they didn't know about the taxing and they were banking on what was in the account, but almost 98% of it went to taxes.
Well, that shouldn't have happened. So that's problematic. That shouldn't have happened because when you have the joint account with the other individual, you need to make sure it's a joint account where both of you guys have equal rights to the account. So if one person passes, the money is now automatically yours and it doesn't go through a probate process, which means CRA, estates legislation, they should not be able to come in and take from that money because it now belongs to you. It's kind of like the same thing when you have property. So another way to, if you own a home, is whomever you're thinking that you want to end up giving the house to, you want to also get them in as in. I'm so sorry. A lot of what I'm saying is going to be very not even Canadian context, but very Ontario context. But I think
it's fine.
I think people can apply the same thinking, sort of like, oh, maybe something similar might be in the States. You want to hold the house, or you want to hold, whether it's a house, it's a condo, you want to hold real property as, again, joint tenants, right? Again, what that means is when someone passes, the property automatically, the whole of it belongs to you. Whereas in Ontario, if you hold it as like tenants in common, so for example, me and my husband Riyadh, if we hold a house tenants in common and I pass, my house doesn't directly go to Riyadh. My 50% of the house goes back into my estate. So it means at some point, my estates can either force the sale of the house, for example, if people within my estate shall choose to do so, and we would have to pay taxes on it. But if it was held as tenants and joint tenants, then when I pass, it's automatically Riyadh's house. No taxes have to be paid on it, right?
So where in the housing buying process or in that process do you actually make that distinction of if you want it to be a joint tenant or a tenant in common? Is that what you said? Tenant in common?
Usually you do it in the beginning when you guys are signing title to the property of the house, but you can change it at any time. You can, it's easier when you're buying, right? Because then there's not so
Yeah.
much scrutiny on the next person that you're
Correct.
putting in on their income and etc. But really, you can do it at any time. You need permission from whoever is your mortgage breaker, because they need to make sure the second person that you're adding on, because they now also take on liability for the mortgage. So there are factors and things to consider, but that's also another way to keep CRA like away from.
So I
or
guess it's
practice.
something that all of us have to be looking for in a purchase agreements to see which one we actually sign, because I don't think I've ever had those
Yeah,
definitions when I
yeah.
was, or if I heard them, they probably sounded foreign to me, and I just wanted to sign all those 5,000 papers they were had in front of me when I was
Yeah,
buying a
yeah,
house
yeah.
or
So check
closing
it.
on a house.
Yeah, so check it and see what kind of like ownership you have. Another way to beat is like the living trust or trust accounts. I don't know the mechanism and how to set this up, but those are things that you can talk to your financial planner about, what that would look like. Again, it's estates planning, but keeping it out of like a will, because everything in a will has to go through probate. When it goes through probate, it gets taxed. So this is a way to try to minimize taxes that you're paying while your estate is paying on assets.
Hey, it's Fumi. Join us for the full episode. It should be on your screen somewhere here, or check down in the description box, and you want to listen to the whole story. Catch you over there.